Welcome to the Boardroom Governance Podcast. I'm your host, Evan Epstein. Before we dive into today's episode, I'm thrilled to share some exciting news. In 2025, I'll be hosting our very first in-person Boardroom Governance Podcast Summit to celebrate the 5th anniversary of this podcast. I'm currently exploring venues in the Bay Area with the goal of bringing together an incredible lineup of industry experts, thought leaders, and innovators who will explore the latest trends, share valuable insights, and foster meaningful connections. Stay tuned in the coming weeks for more details, including how you can register and secure a spot. In the meantime, if you have any ideas for the summit or are interested in sponsorship opportunities, please feel free to email me at evanepstein@substack.com or epsteinevan@uclawsf.edu. Now that you're all in the loop about the big plans ahead, let's turn our attention back to today's show. Our guest today is Tom Callahan, the CEO of Nasdaq Private Market, a secondary market trading venue for issuers, brokers, shareholders, and prospective investors of private company stock. In 2021, NPM was spun off of Nasdaq to become its own independent company, receiving strategic investments from a coalition of banks. In our conversation, we discuss his experiences on Wall Street during the 1990s, the impact of the Jobs Act on private markets, and the challenges private companies face regarding governance and liquidity. Tom highlights how NPM is improving data accessibility and efficiency, while also addressing the balance between fostering innovation and ensuring transparency. The conversation concludes with Tom reflecting on the future of private companies' secondary markets. If you liked the show, please consider subscribing, leaving a review, or sharing this podcast on social media. You can also contribute by subscribing to the Boardroom Governance newsletter at evanepstein.substack.com. The Boardroom Governance Podcast is sponsored by the American College of Governance Counsel. The ACGC is a professional association of lawyers and academics in the US and Canada, widely recognized for the expertise and achievements in the field of corporate governance. The ACGC was founded by some of the most prominent US corporate governance lawyers, and today the organization includes over 150 practitioners and academics. The ACGC's mission is to promote a high level of professional standards among governance lawyers, along with a better understanding and broader adoption of best practices within business organizations. You should check out their website at amgovcollege.org. That is amgovcollege.org. Tom, it is so good to see you again in the Boardroom Governance Podcast. We were in New York not long ago in a program for venture-backed company boards. So it is great to see you again, particularly to talk about some of the issues in secondary markets and private markets that is relevant for directors, not only from private markets, but also public markets.
Absolutely. Evan, it's great to be here. Thank you for including me. I really enjoyed our conversation a couple of weeks ago when you were in New York, and looking forward to continuing today.
All right, so let's dive into your origin story. That's always how I start these interviews. Give us a little bit more sense about yourself, where you're born, where you grew up, and we'll move from there until your role in the Nasdaq private market.
Absolutely. Well, I grew up right outside of Boston, Massachusetts. And you will remember from our meeting in person, Evan, I'm 6'6", so I'm rather large. And my aspiration as a child was not to be a private market company CEO. Shockingly, I wanted to be a professional football player. And so I ended up going to Harvard and playing football. I was over 300 pounds with a mohawk and a goatee. I tried futilely to look as intimidating as I possibly could, but an injury my senior year derailed those dreams, and I was forced to go out and get a real job after graduation, which at that time for me, which is in the early 90s.
Wow, I would have said that you would have gone to basketball, but not football.
I probably look more like a basketball player now, which is good because I'm significantly less than 300 pounds now. But if you saw some photos of me back then, you wouldn't be surprised. So I was deeply in debt after college and needed to pay those debts off. So as they asked Al Capone, why do you rob banks? That's where the money is. Well, I went to Wall Street and became a bond trader. and that was my first job out of college, which was an incredibly fun, rewarding job. But it really then kind of informed the rest of my career because I've been lucky enough to be around long enough to see the arc of development of market structure.
Let me ask you something there because you entered in the beginning of the 90s, right after there was the big hype of the 80s, right? So maybe it felt like you missed the wave a little bit like coming into Silicon Valley in, 2002 or 3. What was the environment like in Wall Street at that time?
Yeah, I mean the stock market crashed in '87, and I started in '91. So the echoes of the stock market crash were still very present. Wall Street was in a deep depression. Interest rates were 9 or 10% at the time,
Mm,
and most importantly, markets were not electronified at all. My first job was working on something called the liaison desk. Now, when brokers around the world want to execute trades, they put it in a computer. Well, they didn't have computers back then, so they made phone calls.
mm.
So it was like working at the phone company. There was about 24 of us on a big long desk with a big bank of phones, and thousands of brokers would call in every day, and we'd answer those, and we'd take their orders, and then we'd run across the trading floor and execute the trades, and then we'd run back, and we'd do that for
Wow.
10 hours a day every day. So
Now we know how you lost all the 300 pounds.
yeah, exactly. Yeah, and we were kind of the low man on the totem pole. So, yeah, there was definitely a lot of hazing and abuse that happened for the young folks on the floor at the time. But I learned a ton. I learned a ton about markets and a lot about market structure, which was amazing.
So you were at Merrill Lynch for a long time, and then you decide to go to New York Stock Exchange. Tell us about that transition.
Yeah, I had a whole bunch of businesses that I ran at Merrill, which was a lot of fun in London and New York. Most of them were trading businesses, but I was there in '07, '08, '09. At the dawn of the financial crisis. And the last business at Merrill that I ran was their prime brokerage business, and we did financing not only of our client positions, but we also did financing of Merrill's own
Mm,
book. And so I had a fairly unobstructed view, Evan, of the horrors of that balance sheet. And I honestly did not think that the company was going to make it. So I started looking for a new job at the end of 2007. A lot of people, they think about September of '08 when as when the financial crisis began. It really began in the summer of '07.
mm.
That's when the financial markets first froze, when the first commercial paper vehicles started to go into distress. So it was pretty clear to me. Merrill was starting to take some very large write downs at the time, $2, 3, $4 billion write downs in Q4 of '07. So I thought, well, if the banks aren't going to make it, the beneficiary will be the exchanges, and all of the OTC liquidity will, of course, be forced to migrate to the exchanges.
Mm.
And so I went to go work for the New York Stock Exchange, and they put me in charge as CEO of one of their divisions.
So that's another very interesting time in the financial crisis, particularly in Wall Street. There was a lot of reckoning, and then in New York Stock Exchange, how did you move into that market? And clearly, that was an interesting time before you moved to another big player, which is BlackRock.
Yeah. Well, at the time, it was an interesting time. So I got to NYSE in March of '08. And what was happening in kind of the late double O's is the U.S. futures industry was consolidating. There used to be like a dozen futures exchanges around the country, and they had all consolidated. And right before that, the two last big players, the Chicago Mercantile Exchange and the Chicago Board of Trade, had merged.
Mm,
So you had this natural monopoly that still exists today, by and large, in the U.S. futures industry, and there was a lot of banks that were very concerned about that because the banks are big users of futures, and no one only wants to have one
mm,
provider. So there was a U.S. futures business of the New York Stock Exchange that was very small, and a bunch of the banks approached the New York Stock Exchange and said, "Hey, why don't we spin this out into a private company? Or we're going to try to create a challenger and try to create some competition in the U.S. futures industry. So that's what I did.
Mm.
We spun that business out. We raised a bunch of capital. We ended up building a new clearinghouse with DTCC in New York, and had some success. We launched some products that are still very successful to this day. And then when the New York Stock Exchange was acquired by the Intercontinental Exchange, now goes by ICE, in 2013, we sold that business to ICE as part of that acquisition.
Hmm. Okay, I see some connections to what you're doing now with Nasdaq Private Market, but we'll get to that when we get there. And so then you move to BlackRock, which in the world of corporate governance is like one of the big institutions that is very influential in corporate governance, in what boards do in public companies, and increasingly in private markets. But tell us about your move to BlackRock and what was your work there?
Yeah, so I'd say the common theme that's run through my career is I've always either been building new businesses or fixing broken ones.
Mm,
So I'd say the move to BlackRock was very much goes under the topic of fixing a broken one. My independent board director at NYSE was a guy named Richie Prager, who was the head of global trading at BlackRock. And so when we sold that business to ICE in 13, he said, "Hey, have you ever thought about coming to BlackRock?" And I told him honestly, I was like, BlackRock had been my largest client in all the different jobs I had most of my career, and I never really thought I'd get the chance to work there. So when he mentioned it, I had planned on going off and doing another startup, but the opportunity for BlackRock seemed too good to be true. And so the business they gave me to run was one that had fallen in hard times. Going back to the conversation about the global financial crisis, for those of people who remember that event well, the nexus, what kind of started it all, were money market funds. A lot of the banks
mm,
had put risky assets into what are ordinarily very safe money market funds. Many of them broke the buck, as you'll recall, and needed to be bailed out. And sort of that was the first wave of the financial crisis in late '07, early '08. Well, BlackRock had a very large money fund business. In fact, it was one of the businesses that started BlackRock in the late '80s. Now, BlackRock is a very well managed place exclusively. As part of being a founder led company, you've got Larry Fink, obviously, and Rob Capito,
mm.
probably two arguably of the most successful financial markets entrepreneurs of our generation. And the place is incredibly well run. But the money market business, and now we're talking about 2013, it was a combination of zero rates. It's very hard to run a successful money fund business and a product that yields zero, and that's where we were. And there had just been a lack of confidence in the money fund industry in general because there were so many problems in the crisis. So they brought me in 13 and said, "Listen, we really don't know what to do with this business, but we're going to give you a lot of latitude to build it, grow it, change it. And why don't you see what you can do?" And so it was an offer that was too good to be true. And it was, kind of a classic rebuild. I had to change all the products. I think they had something like 58 money funds when I got there, and I cut that number down to like 15. We did 4 acquisitions. We rebuilt all the tech. I rebuilt the team. So they had 250 billion in assets when I got there in 2013, and when I left in 22 to take this job, we had 750 billion. So we added a $500 billion in assets in the time I was there, and it was great. It's an amazing company, and I built an awesome team, and we had a lot of success together. But the entrepreneurial itch inside me was still scratching, and I have this bad habit in my career of clawing, fighting, scratching to get to the top of a mountain. And when I get there, I just want to go climb the next one. So
Yeah.
I would say that's probably what happened at BlackRock. Still have amazing friends and connections and just really valued my time. But it was time for me to go do something challenging and entrepreneurial.
All right. Well, that takes it to Nasdaq Private Market. So I live in Silicon Valley, and secondary markets have been prominent for at least 10 years. And second market that was later acquired by Nasdaq Private Market became a player. There was different entities, And so there's been an evolution in the last decade. Why don't you give us a little bit about the origin, mission, and vision of the NASDAQ private market, both for people who know about it, but also, more importantly, for directors who don't understand, and we'll dive into what NASDAQ private market does, because I know that a lot of people are not aware about what happens in this structured liquidity events.
Sure. Well, Evan, I think it helps to just start to frame out like what are the private markets, because
Yeah,
people use
yeah.
that, and there's this sort of massive alts universe that includes a whole bunch of assets, private credit, private equity.
Hmm.
Let's sort of define our terms here. So when I talk about the private markets, what largely I'm talking about are venture-backed, pre-IPO private companies typically worth $1 billion, what they call unicorns or close to it. And it really is a fascinating market that has just erupted in size in the last 15 years. And I don't think it's talked about enough. And I don't think it's understood
Hmm.
enough, because the impact on the US economy and US innovation and US competitiveness is absolutely profound. So let's just start with some numbers, because I think it's helpful.
Hmm.
20 years ago, there were something like 8,000 publicly traded U.S. companies. Today, you have something like 3,200. It's kind of the joke. We have the Russell 5,000. There's not 5,000 publicly traded U.S. companies. There's less than that. At the same time, and you live in the Valley, and it's your market and your community, so you understand. You go back 15 years, you could count the number of unicorns on one hand, right? It was Facebook and Zynga and Groupon, that sort of early.
Well, the first pitch on TechCrunch, when they wrote about unicorns, Eileen Lee, they found 39 unicorns, and
Yeah.
that's 2013.
Yeah, so very few, and that's probably globally. So it was a small number. Now I think there's something like 1,200 unicorns. So
Hmm.
something profound has changed, where the number of publicly traded companies dropped sharply, and the number of unicorns has grown almost exponentially. If you look at the value today of those unicorns, it's somewhere around 3.5 trillion.
Hmm.
That's about the size of the U.S. municipal bond market. That's a huge, huge market. And at the same time, it used to be that private companies IPO'd at about 5 years, because there was a restriction on the number of shareholders they could have. It was 499 shareholders, including
Hmm.
employees. And so that cap was raised in 2012 under an Obama piece of legislation called the Jobs Act. And so now they can have over 2,000. So it just made it easier for private companies to raise capital as private companies. And so as a result, the average company now, I think, waits 12 or 13 years to IPO. That's a very profound, important
Mm.
change in the American capital markets, frankly, that I don't think is really discussed. Because let's play it out, Evan. I mean, what happens if this trend continues another 10 years, which I think it will? And what if we go from 3,200 publicly traded companies to 1,500?
Hmm.
What if we go from 1,200 unicorns worth 3.5 trillion to 3,000 worth 10 trillion? All of a sudden, it's a pretty open question. What's the tail and what's the dog? Is the public
Mm.
market the dog and the private market's the tail, which is what most people have always thought? Well, what if that inverts? And if the nexus of liquidity and innovation is actually the private market? And so I just think these are questions that aren't being discussed and debated more broadly. So MPM was started within NASDAQ in 2013, right after the Jobs Act that I just referenced.
Hmm.
And I think there was concern at NASDAQ at the time. Well, what if the Jobs Act means that companies are going to wait longer to go public? And hey, given NASDAQ's business is listing public companies, shouldn't we have a service offering for private companies? And so, those early generations of tenders, there was actually just a Wall Street Journal article last weekend about
Hmm.
this, talking about that early generation of Facebook tenders. They were done by law firms. They were done on email. They were done on spreadsheets. They were expensive. They were confusing. And so NASDAQ built a piece of technology to streamline and automate all of that. So why do private companies do tenders? Well, think about it. If you're going to
Mm.
wait 10 or 15 years before you IPO, your employees all get equity, but it's kind of hard to say to a 25-year-old software engineer, hey, congrats, welcome to the company. You're going to have to wait till you're 40 to buy your first house, right? That's
Right.
hard. So private companies have to offer liquidity along that journey to their employees, frankly, to keep them in their seats and to be able to attract and retain the best, especially if you're competing against a publicly traded company, right, that offers the typical 3-year cliff vest RSUs that have this automated built-in annual liquidity mechanism. When you've been there a while, you sort of have to create that equivalency within a private company. So that's where our tender business comes
Mm-hmm.
in. Tenders are where the private company hires us to run these programs in a very efficient, organized way to offer partial liquidity to their employees.
So let me ask you there, because there are a lot of foundational questions here. So, number one, there used to be a vision that founders and companies should be poor to use that word until the IPO, because then everybody is aligned and investors would know that you are aligned to have this IPO and everybody would get paid there. When tender offers started happening and some founders were getting, millions of dollars out in series, B, C, D, E, whatever it was, there was a pushback, and there's a philosophical pushback. So can we talk about that? What is the right number? How do you see this trend? There's not a rule, and there are practices here, but I think there's been an evolution of thinking about this. And then let's talk about the second topic, which is companies staying private for longer. So in Silicon Valley, there's been a lot of debates about, hey, you don't have to go public. You can just stay private and you can raise money in the private markets, and it gives you all these advantages. You don't have to deal with short sellers, activist investors, SEC, all the pressures of running quarterly companies, and it gives you more control over your company. So let's tackle the first one. How do people think about secondary for founders, employees before the IPO? And then how do people think about staying private for longer?
Well, Evan, you really said it absolutely perfectly. There's sort of an old school thought in the Valley on liquidity, which is, I don't like it. I'm a venture investor. I want interests aligned. We all get rich together when this company IPOs, but until then, any form of liquidity
Mm-hmm.
is bad. And there are still some old school VCs that think that way, but there's fewer and fewer and fewer. Again, asking people to wait 5 years for liquidity, which is how long it used to take companies to IPO, is one thing.
Right.
Asking for 15
Right.
years, and there's plenty of companies that are 20, 25 years and they're still private, it's just not a reasonable ask. You cannot hire and retain the best talent unless this is an issue that you address. I mean, we are a private company ourselves, Evan.
Mm-hmm.
I have something like 50 software engineers that work for me. Most of these software engineers, by the time we hire them, have worked at 2 or 3 other private companies. They show up talking like Goldman Sachs investment bankers on the topic of shareholder liquidity and tenders, investing schedules. They are deeply fluent in this topic. So they ask really specific questions because some of them have burned in the past. And so they need answers. So I think that's a big part of it. The other part is that this: the average length of a venture vehicle is 10
Mm-hmm.
years. And so, with the average company now waiting close to 15 years to IPO, you have an asset liability mismatch. And I would say it's one of the biggest problems in our market is that you have venture funds that are end of life. So it's a 10-year vehicle that is at 10 years. They've still got good, viable, fast growing companies that are succeeding and innovating and disrupting and doing all those things you want them to do, but they're just not looking to IPO in the next 12 or 18 months. So what do? You know this, right? Your options are not great. You can try to sell the position. You can try to do a continuation fund, which is basically launching a brand new fund. You can do strip sales. None of these are easy. None of these are cheap. And so, probably the most straightforward option would be just to be able to sell the position, but that then requires a robust secondary market. So I'd say, venture, who historically was very resistant, as you rightfully said in your question, to the whole concept of liquidity, are now very much pro liquidity because they need it.
Mm.
Their business model does not work without it, right? I mean, let's just talk about the basics of how venture works. You raise a fund, you invest in it, you deploy capital, it succeeds. There's M&A or IPOs. That capital is returned to the investor. Then you launch your fund two, and you recycle the capital. Rinse, lather, repeat. Fund 2, 3, 4, 5, 6, 7. Well, if there's no DPI, there's no return of capital, then those investors have no money to give you to launch your new fund. So the conveyor belt sort of stops. So we need secondary liquidity to support the venture business model. And so that has caused a profound change in thinking.
So that's a great way of putting it, because historically people always thought of exits and liquidity via IPOs and M&A, and M&A, played a huge part of it. But now there's a third window, which is these tender offers. And I remember when Masayoshi Son and SoftBank came along, $100 billion vehicle, said, hey, you don't have to IPO, you don't have to sell, you just, we will buy, we will invest, and we'll give you this tender offer. And I remember, I think in Uber or one of these companies, they came in and they invested billions of dollars and they bought this share of Benchmark or whatever VC firm sold at that level. And that was the liquidity. And that was interesting, right? Because it's changing the dynamics in which venture is operating, in which companies are operating. So how much of these liquidity programs are targeted to sell investor stakes versus employee or founders? Because each one has a different interest, so to speak. And I think each one wants a liquidity, but there are differing incentives here.
Yeah, another very perceptive question. So I'd say the main motivation for the majority of tenders is employee liquidity, but there's also the issue you just referenced, which is cap table cleanup. If the company is preparing for an IPO, there may be investors, even some very large, sophisticated investors that have been with them from the start, maybe 10,
Mhm.
15 years ago, but they're not necessarily going to be there for that next journey as a public company. So there's a recycling of the cap table that needs to happen. Oftentimes, and we get this call quite often, think about in your angel and seed rounds, you may have borrowed 100 grand from your father-in-law in a pre-seed round. Well, that's now worth $18 million, and your father-in-law is calling you every other day, asking when he can get his money back. Can you please, have a mechanism to kind of liquefy those early round investors? So those tend to be the motivations and the targets for why companies run tender programs.
So sometimes you're saying that they will run a tender before the IPO to clean it up. And my question there is, if you're the person who put the 100,000, which is worth 18 million, why wouldn't you wait for the IPO? You're just thinking that you'll get a better liquidity, or you want it now and you just don't want the risk of waiting, and the IPO, you never know.
Exactly.
Okay.
You never know, or maybe the IPO
Yeah.
never comes. But your question, I think, was maybe even a bigger question, which is, what is the function of the IPO? It's every entrepreneur's
Mm.
dream to be standing, at the podium of Nasdaq, IPOing your company. But let's unpack why companies IPO. It's a massive PR event, and that's great for companies. Oftentimes, companies will say it gives you a currency to make
Hmm.
acquisitions, and that's valuable. But let's be honest, liquidity for employees, for founders, for investors is a massive reason why companies go public. And oftentimes, you'll see these high
Mm.
profile IPOs that are 100% secondary. The company's not raising working capital; it's a liquidity event. And so,
Mm.
for a lot of companies, that IPO, that classic IPO route, makes all the sense in the world. But for other companies, it just doesn't. I mean, SpaceX, I think, might be the most valuable private company in the world right now. Elon Musk has sort of publicly speculated that he may never make that company public. I
Mm.
personally have had multiple conversations with CEOs of unicorns. Many of them have told me they have no intention of going public anytime soon, even though they could. I had a very
Mm.
memorable conversation with the CEO recently who was reflecting back on the time as a private company during COVID, when their core business was hit very, very hard. The revenues dropped, and their business is a relatively high margin business. And he just said, Tom, I just decided I wasn't firing anyone. In fact, I was going to continue to hire. I took my margins to zero. I wrote it out. We hired some amazing people. And then when the market turned, I was so grateful that I did that, because now their business is 10x. And he said, if I was a public company CEO and I chose to do that, I would have been fired, right? When you're managing the quarterly, results, to say,
Mm,
well, I'm going to ride out the storm, take my margins to zero, and I'm actually going to take my costs up, not down. You'd be carried out in the next day. So, really, it then gets to the question is, what is in the long term interest of the company? And to the degree a company decides they want to stay private, while being able to address that big motivator that we just
mm.
talked about of liquidity, if you can address that in the secondary market, then you go public if and when you want to, but you're not forced to.
Yeah, I think this is a great debate because I remember Mark Andreessen years ago said something like, there's never been more patience for private companies and more impatience for public companies. And that was maybe 10 years ago when he said that. And it's still true in the sense that in your board, when you have private investors, they're giving you a leeway to run it the way that you want. But also there's been a pushback from some sector of VCs that say, look, it's actually a very healthy thing to go public because it requires you to do all these governance changes. And, for example, Mark Zuckerberg has said, that was a very important thing for Facebook when they did it because it forced them to do things in the proper way. And, let's use the analogy of being a grown up, right? Like you don't have to be a teenager. And the question then is, what kind of controls do you have over the private companies? And it's an interesting question. A few years ago, and let me put you this question, the regulators and the SEC was kind of vocal and kind of said, "Hey, these are unregulated markets, and we got to shine a light here." And it puts the private markets in a place that hasn't been before, in part because of what you said at the beginning. It's becoming very large, very important. It didn't used to be that way, and so people are looking at it. We have a change of government now, so we don't know what the new SEC is going to look like, or regulatory enforcement, or at least oversight is going to be like. But let me ask you from that perspective, is it your view that you want to have a thriving private market where NASDAQ private market could be the liquidity source, and that could be more efficient than operating purely on a public company side? Like, how do you think about this?
Yeah, a great question. And my answer may surprise you slightly. You think that most people in seats like mine would always be advocating for deregulation and less regulation. But I believe there is such a thing in this world as overregulation. I also believe there's such a thing in this world as underregulation.
Hmm.
And the private markets are underregulated. It's interesting, Evan. It's almost like they're this surprise market. This is my job and my career, and I talk about them all the time. I talk to very sophisticated people that have been in and around the public financial markets their whole career, that work at big banks and big funds, and a lot of them are sort of surprised to hear about how big and sophisticated these markets. It's almost like it's in the last 15 years this $3.5 trillion surprise that snuck up on everybody. But back to our earlier conversation about what's the tail, what's the dog. At some point, these markets are going to be so big, and maybe there'll be more unicorns than there are publicly traded companies. At that point, the SEC is going to be forced to reckon with these markets. Now, please don't misunderstand me. I'm not advocating for over regulation, but there are some basic principles that regulators have applied to every other asset class on planet Earth quite successfully, and they're sort of the foundation, the regulatory foundations that allow markets to function. And they don't exist in this
Mm,
market, and they need to. What am I talking about? Things like, for example, central clearing. There is no
mm,
DTCC of the private markets. We have a clearing service in NPM, and a lot of private companies hire us to clear all their securities. But you may be surprised to learn that in private markets, settlement times often run between 30 and 90 days. When
yeah.
you sell a share of Apple, in your Schwab account, the money's there like that day, right?
Yeah.
And you never even think for a moment about it. Well, in the private markets, sometimes you have to wait many months, trades fall apart. You can't have an efficient asset class
Mm.
with that kind of inefficiency. Another basic regulatory premise that applies to every other asset class are public reporting of transactions. The bond market has Trace, run by FINRA. You have tape A, B, and
Mm.
C in the public markets so that people can see where trades are happening. Well, imagine a world where that didn't exist. Things get very difficult very quickly. Well, in the private market, there is no tape. So if you, as a sophisticated institutional investor, want to buy, Acme company, it's not often easy to find out, well, where was the last trade in Acme company? Is it up from the last primary? Is it down? And then, of course, in the private markets, a stock's not a stock. You've got common, preferred, A through whatever. All those shares have different rights, restrictions, fully diluted share counts. It gets complicated pretty quickly. So maybe just to
Mm.
tie that thought all together, I'm often asked by people, well, what are the big differences between private markets and public markets? And my answer is always the same, which is information asymmetry. All of the regulation in the public
Mm.
markets is engineered to create fair outcomes, level playing fields where the 70-year-old retiree in theory has access to the same information as the Greenwich hedge fund, right? It's all meant for level playing fields. Well, in the private markets, there is no level playing field because there is no publicly available information. If you're an investor in a private company and you sit on their cap table and maybe you sit on their board, you know everything about that company. If you don't, if you're just looking to establish a new position, you know nothing. Private companies have no obligation to disclose anything about their financials, about their shareholders, about their performance, about their forward looking outlook, about their risks. Nothing that public companies have to report on. And none of those rules are applicable. So I just think in time, there's going to be a convergence between the public markets and private markets. Now, I hope where it doesn't land is where there's overreach and private companies are overregulated or maybe regulated the same as public companies, because I think that
Mm.
will have a incredibly negative impact on innovation. And innovation is really the heart of what distinguishes the American economy. So I hope that they don't kill the golden goose with overregulation. But as I said, there's such a thing as underregulation, and
Mm.
that's where we are right now.
So disclosure of information is critical, and as you said, the key issue here is information asymmetry. I understand that you have created an NPM, a tape D pricing, where you create some level of transparency or better transparency over pricing, because you have what, about 400 institutional investors that may buy these private company shares. What are they looking at? How do they make their decision when in a public market that's all very transparent, in a private market it's not? So maybe you can walk us through that kind of exercise.
Yeah. So most investors are fiduciaries. And as a fiduciary, you have to meet a fiduciary standard before deploying capital. And, there's a lot of go private companies that you see on CNBC all the time, and they're making headlines and everyone knows them and they seem really exciting. Well, it's not really enough to make an
Hmm.
educated investment. You want to understand, how is the company growing? What are their sales? Are they profitable? How much cash do they have on the balance sheet? What are their future capital raise needs? What are their growth rates? All those basic information things, you don't have them as a private market investor unless you can get them from the company.
Mm.
So, what can you get? Well, as it turns out, there's a lot you can get in the public realm. One of the great sources of information is something called a COI, a certificate of incorporation. Most private companies in the US are domiciled in Delaware. So you can go to Delaware and you have to do it one at a time with your credit card, and you can buy a COI for a private company. It's a big pain, but you can do it. So we do go to the state of Delaware and we buy thousands and thousands of COIs and we digitize them and we make those available at our investors' fingertips. There's other places you can go. Of course, we trade these names. So anytime these names trade on our platform, we have bids, offers, match trades. We make that available. mutual funds that own private companies are on a quarterly basis, sometimes monthly basis, forced to disclose their marks. So we're able to pull those mutual fund marks. So that's really helpful, right? That's where the largest, most sophisticated asset managers in the world valuing this company. We make that available to you. There's other information that we get as well, but essentially all this stuff is public, but really hard to get. So yeah, you and your investor team could go spend 3 weeks trying to pull it all together. If you come to the MPM platform, all that information is just made available at your fingertips. So that's what we call our tape deed price.
Okay. Yeah, I mean, clearly there should be some level of disclosure there when people are making informed decisions. And I think the big driver, I understand that 2021 was an extraordinary year. Everything was up. IPOs were up, M&A was up, everything was up. But 22, 23, everything was down. 24, things are coming back, and I hear that the secondary markets are coming back stronger than ever. Tell us about your year 24 and also the role of AI, because in Silicon Valley, it's everything about AI. You look at OpenAI, you look at Anthropic, you look at XAI raising billions of dollars. I mean, records. I think OpenAI has $159 billion. XAI started, I don't know. I don't know if it's even a year ago, and they're already at $50 billion. So everything is very shiny, and they are doing a lot of activity here. Tell us about 2024 and AI in this market.
Yeah. So you're absolutely right. 22 and 23 were incredibly difficult years in the private markets because we had the bubble in 21, and then the Fed started raising rates, and that bubble quickly burst, and the private markets and public markets kind of crashed at the same time in 22. But the public markets recovered very, very quickly. Well, the private markets didn't. They crashed in 22, and they stayed crashed, and they started to kind of recover a little bit in the Q1 of 23. And then, of course, infamously, Silicon Valley Bank went bankrupt in March of 23. And people that aren't in this market, but you are, so you know this, Evan, like SVB was at the center of the innovation economy. So many private companies had not just banking relationships, but they had their personal wealth and their personal bank accounts and their mortgages with SVB. So when SVB went down, and they were the biggest by far in venture lending, so they were kind of just at the heart of the whole innovation economy. And when they went down, you took a market that was already weak, and you just, frankly, just kind of like shot it in the head. I mean, 22 and 23 were brutal years. Our tender business was down 70 or 80%. Companies were just not focused on employee liquidity. Private companies were focused on survival. They were focused on lengthening runways. Many were laying people off. It was a survival time. And then you also had this other weird phenomenon where it was really hard in 22 and 23 to figure out what a private company was worth. Again, we don't have a public tape. There was very little transaction volume. Bid offers were a mile wide. So classically, if you want to know what a private company is worth, you look at the last funding round. And in a bull market, companies go up every funding round, right? Well, you had companies in 22 and 23 who, based on either private comps or public private comps, were down 50, 60, 70, 80%. So all of a sudden, that metric that we'd all relied on as the indicator of value for many companies became irrelevant. And if there's no trading, how do I value this company? And so all those kind of forces conspired together to create a very, very difficult environment. But time heals all wounds. As we got into this year, our market got busy almost from January. It started with the tender business. We executed more tenders by April of 24 than we had in the full year 23. And we've done over 2x, both in notional volume and in number of tenders in 24 versus 23. It's almost like there's this latent demand for liquidity that all sort of erupted all at the same time. And that's on the tender side of the business. On the trading side of the business, so that's away from a company-sponsored tender. That's just where a employee or former employee has a vested position in
Mhm.
private stock and they just want to sell them. So in
Mhm.
that situation, the employee is the client. On that trading side of our market, that stayed pretty quiet, largely, I think, because of this ambiguity around valuation until around the 4th of July. Um, and in the last few months, that business has really started to pick up in a very, very big way. So, as everything we're seeing for 2025, of course, none of us have crystal balls based on the levels of activity, the pipeline, the conversations we're having with private companies. And again, the fact that we still have this immense backlog of liquidity from companies, from investors, from employees, and it's really now just starting to be addressed. We're pretty optimistic that 2025 is going to be a great year. Now, on your second question, which was about AI, and that's a really important one, AI has been kind of the story of the
Mhm.
public markets in 24 and of the private markets. You have real concentration of leadership in the public equity markets, the Magnificent Seven or
Mhm.
whatever they call it. In the private markets, things are no different. The hottest names that everyone wants to own are all the big, AI names or
Mhm.
names associated with Elon Musk, and sometimes those things overlap. So those really kind of what led us out of that difficult period earlier this year. And liquidity is slowly starting to broaden. There's still very, very concentrated liquidity in the private markets, but you're absolutely right. AI has been a huge, huge part of the private market story in 2024.
Yeah, I mean the way I see it, and you closer to the information because you see the companies. It's almost a tale of two cities where AI is pretty much 21 on steroids, and the rest are reckoning and having to deal with down rounds, recaps, and having to clean a little bit all the repricing. So there's a lot of pain out there, and we've seen the record number of layoffs in tech has been hundreds of thousands. So I think that's still playing, but 25 looks better for everybody, seems like.
Well, I think one of the most exciting things that appears to be happening, and we're owned by a consortium of 11 banks, so we get pretty good information. Everyone that I talk to in M&A has said that since the election, their
Mhm.
activity levels have gone up massively. And not to introduce politics into it, but I
Mhm.
think it's a fact that the M&A pipeline and deals that I think under Lena Khan had no chance of being approved now look like they probably will. So there's two paths for private companies to achieve liquidity: M&A and IPO.
Mhm.
And so on the M&A side of things, there's just no question things are significantly busier. And the IPO pipeline appears to be, it's been one of the longest droughts of IPOs in the history of American capitalism in the last 3 years. And that appears to be changing. And the forward looking pipeline of IPO candidates looks to be really, really exciting. So, what does that mean for private company investors? Well, think about it. If you're going to invest in a private company, even if you love the company, you love the business, and you're wildly bullish, there is one fundamental question as an investor you need an answer to above all, which is, what is the duration of this investment? Am I making a
Mhm.
1 year investment or am I making a 10-year investment? I don't know. Because, of course, as a private market investor, you're not getting dividends. So you're playing for the capital appreciation, and you only achieve that when there's a liquidity event of M&A or IPO. So when you get greater confidence that there will be M&A, or sometime in the next 12 to 18 months, this company is likely to IPO, it just gives you greater confidence
Mhm.
as an investor because you know the duration of your investment. That's a question you haven't been able to answer for coming up on 3 years now. So I think more than anything, that's why we're seeing this sort of unlock of activity in the private markets right now.
No, that's great. So these papercorns, as some people call them, will have some sort of liquidity. Is there any other board issue that we did not address and that you think would be important to highlight for corporate directors? I think we covered a lot, but I just want to make sure that is there anything that I missed?
No, so I'm a consortium CEO. So as I mentioned, we're owned by a consortium of banks. It's my second go round as a consortium CEO. So all of the board governance challenges and issues are on steroids as a
Mm,
consortium CEO. So I spend a huge amount of my own time talking to my board members, understanding. Banks are conflicted because they're competing with each other, but I always say, if we can harness the power of our partnership and manage the conflicts, we can achieve incredible things. And that's what we're doing. So, yeah, that's why the whole conversation around board governance
mm,
is near and dear to my heart, because they're issues that I spend a lot of time dealing with. But I think more broadly, we covered an awful lot of ground on
mm.
this call.
Yeah, so let's do the rapid fire questions. What are the one, two, three books that have greatly influenced your life?
Well, I always say at the top of the list is How to Make Friends and Influence People, which is a
Hmm.
big book that was written in 1935. I always recommend that to people. It's as relevant today as it was then. It's the basics of how to deal with people. And yeah, we all work in a technology enabled world, but success in life, success in business, always comes down to your ability to deal and manage with people. And there's no better reference guide that I know of than How to Make Friends and Influence People. The second book that I always recommend to everyone is a book on negotiation by a guy named Chris Voss called Never Split the
Mm.
Difference. Everything in life is a negotiation, and it's something that so many people are terrified of, right? Deciding what to have for dinner with your wife is a negotiation sometimes, and it's an approach to negotiation that makes it win-win, takes out a lot of the conflict. I think that's why people are afraid to negotiate, and why some people never do. Even if it's buying a car, it just fills them with anxiety. And it's a different way of thinking about negotiation that makes it not confrontational. And I think if you can approach it in that way, people can be better negotiators and succeed. And one of the things that I love about the book, Chris was a FBI agent and was in
Hmm.
charge of hostage negotiation for many, many years, and talks in the book about something called tactical empathy, which is if you can just empathize with the person. So, someone robs a bank and he comes in as the FBI agent. Before he starts, negotiating and terms and money, he just listens and tries to be empathetic. Doesn't endorse anything, but just listens. And he said more than half the time, if you can just be empathetic and listen to people, that person grabbed a gun and went into the bank for some reason, and if you can just make them feel heard, oftentimes that alone would resolve the conflict. So that really was powerful. So yeah, those are the couple books that I would recommend to people.
All right. And by the way, I'll put all these in the show links. Who are your mentors and what did you learn from them?
Well, I was incredibly fortunate to have some mentors when I was at Merrill Lynch, which it's really kind of sad what became of that business, because there was a long time they used to call it Mother Merrill, and the people that built and ran that business for a long time were people that did it with a lot of heart, and they were really ethical people, and the company was treated like a family, and they never wanted to do anything that would hurt the family. Now that changed later. We got a new CEO who brought in a whole new cadre of outside people. But for the majority of the 15 years I was there, I was just blessed with people that knew how to do business, but they did it the right way. And they were never going to sacrifice their personal reputation or the reputation of the firm for a short term buck. And they were always in it for the long game. And it was a culture where you had to treat people the right way, whether they were very junior people or very senior people. And so that, for me, is how I've tried to lead, and to try to lead with heart and with empathy, and to listen. So I was just blessed to have three or four mentors. At the time, many of whom, some of them are still working, some of them are retired. We have a little alumni group
Mm,
of
yes.
friends, a guy named Harry Langsfield, a guy named Gerald Mann, a guy named Robbie Coughlin. We have dinner together once a month, and I still find it an incredible source of inspiration. And and they check me when they feel like maybe I'm not, doing things exactly as they think I should, which is always good to be kept humble.
Yeah, that's always great to have this group of people that you can, touch base on a monthly basis or something. That's good to hear. Are there any quotes you think of often or live your life by?
Yeah, so I've got four daughters, and
Wow.
two are out of college, two are in college. But there's a quote that I would say to them over and over, to the point where I typically get eye rolls and groans when I say it, because they've heard it so many times. I'm sure you know the quote is the famous Henry Ford quote: "Whether you think you can or think you can't, you're right." Well, all four of my daughters use that as their high school yearbook quotes, and I believe it. I am an optimist. I surround myself with optimists, especially as an entrepreneur. There's, I think, sometimes from the outside looking in, maybe these jobs look quite glamorous. I tell you, being an entrepreneur is an exercise of getting punched in the face most days, right? It's just this climbing this wall of no.
Yeah.
No, I don't believe in your vision. No, I don't want to invest in your company. No, I don't want to join your company. No, I don't think this is the right strategy. All this stuff, and you just have to believe in yourself. But like, it's kind of hard. No one's got that much conviction, without validation. So you need to be surrounded by positive people. And there's days as an entrepreneur, things just feel impossible. I mean, we did our own Series B, uh, fortunately, in
Hmm.
2023. Our results weren't great. The market was terrible, and I had to go out and sell the story of this company. And I got doors slammed in my face, all over the valley, all over New York City. And it was brutal, but you have to have a team around you of optimists and positive thinkers that believe whether you think you can or think you can, you're right. I have found that more than anything to be the key to success as a small company CEO.
Let me ask you there, because as a CEO of a startup, well, as an entrepreneur, it's very different, the ethos here in San Francisco to New York. And people tend to be, at least here, more positive or future oriented and taking more risks. Is there like a big difference philosophically running the company in New York to San Francisco, the Bay Area?
Yeah, I've never been the CEO of a venture backed company, but I know a lot of people that have, and I know a lot of people that sit on those boards. I think there is a very fundamental cultural difference. And this is an
Sure.
oversimplification. So you could probably pick 20 examples where this wasn't true. But in general, I think venture views their role as, yes, investing and providing capital to a company, but also strategic vision and support, i.e., they tend to be very supportive of management
Mm.
until they're not. But while they're there and on the board, that tends to be a positive supporting relationship. In general, the relationship in New York tends to be more adversarial. I would say that, board meetings
Mm.
with a lot, especially bank investors, can tend to be pretty bare knuckled affairs.
And you've got 11 of them.
Yeah, and they take their job
Yeah.
as governance and oversight
Yeah.
incredibly seriously. So I do think, and that's all good. It's
Hmm.
all fine,
Yeah.
and both models can work incredibly well. But I do think there is a fundamental cultural difference between the two.
Okay, two final questions. What is an unusual habit or an absurd thing that you love?
Well, I'm a pilot,
Oh,
and I
wow.
have been for 20 years. And so my passion in life, when I'm not working or spending time with my amazing daughters, is I'm a volunteer pilot for one of the largest dog rescues on the East
Wow.
Coast. It's called Home for Good. We've been around for 10 years. We've saved over 14,000 dogs.
Wow.
So we have a facility in Aiken, South Carolina, where we take in the dogs because they have a terrible stray problem down there. So we pull dogs out of the high kill shelters, many of whom euthanize. Sometimes dozens or over 100 dogs a week.
Wow.
And so we pull those dogs out. We get them the care that they need, and when they're ready for adoption, we have volunteers that drive them sometimes. But I will fly down and pick up the dogs and bring them to New York, and they go into foster until they're adopted. So if you Google my name before you see anything about Nasdaq Private Market, you're probably going to see videos of me in airplanes and dogs. But it's
Oh,
a
wow.
huge passion of mine.
This is why I'm so happy to ask this question, because you find out things about people that you would not normally know, although you say it may be the first hit on the internet. Okay, final question. Which living person do you most admire?
I'll go with the fan favorite here. I'll go Taylor Swift.
Okay.
She's created her own global economy. She impacts the GDP of every nation that she goes to. How can you not
And you're the
admire?
father of four daughters, so you
And I'm
must be
a father of
very
four
immersed.
daughters,
Yeah.
and they all love Taylor Swift. But how can you not admire someone who is their own global economy? I don't know if there's ever been anything like it. So let's go with that.
Okay, Tom, thank you so much for your time to talk to me about secondary markets, NPM, and everything else. I hope to see you soon again, but this was great.
It was an honor to be here, Evan. Thank you so much, and hope we get to do it again sometime.
Thank you for tuning in to the Boardroom Governance Podcast. If you like what you heard, please consider subscribing, leaving a review, or sharing this podcast on social media. You can check out all the details related to this podcast at the website boardroom-governance.com, and please feel free to subscribe to the Boardroom Governance newsletter at evanepstein.substack.com.